Mid-America Apartment Communities is a real estate investment trust that specializes in the acquisition, development, and management of apartment communities. MAA primarily operates in the southeastern and southwestern United States, which is a popular area right now where a lot of Americans are migrating to. Just like the entire REIT sector, MAA has been down this year, with the stock seeing a decrease of over 17% year to date. Looking in the longer time frame, the company is up over 30% in the last 5 years. However, this is without including dividends. Dividends are a big part of the reason why investors invest in REITs, and MAA pays out a yield that is currently sitting at just under 4.3%. Let's move over to our QuantView Stock Insight tool to get a broader insight into how MAA is performing. As we can see here, the revenue has been going up very nicely over the past 10 years. This is a recurring trend we can see in the EBITDA and funds from operations as well. Their AFFO per share has been flat for some years, but in general it has been in an uptrend. This flat period has been caused by their share count dilution in 2017, which they used to acquire more property. Unlike a lot of REITs, MAA doesn't dilute shareholders by that much, yet they still have been able to increase their dividends on a great pace. Their average dividend growth rate in the past 5 years has been sitting at just over 6%. Their debt position is one of the most robust ones in the industry, and it keeps dropping every single year. Their debt to EBITDA is under our preferred 5 times debt to EBITDA, and it keeps dropping. But this is something we'll get into a little bit more in the next segment of today's video. And by the way, if you want to get access to the Stock Insight tool and all of the valuation models that we'll be using in this video, be sure to check out my Patreon link in the description, where you can get your hands on a bunch of spreadsheets to enhance your investing journey. And with that out of the way, in today's video, we will be taking a 3-step approach to thoroughly evaluate MAA and determine its fair margin of safety. In this step, we'll assess MAA's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into MAA's financial statement and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as funds from operations and discounted dividend model to gain insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market based on different metrics. And in conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of Mid-American apartment communities as an investment opportunity. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we are using 4 colors in a scale, bright red mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction. When we're using 3 colors, bright red mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. As you can see, the EBIT has gone up over the years, going from just under $150 million in 2013 to over $500 million in 2022. The average EBIT growth during this period has been sitting at 18%, which is in the light green part of a scale, indicating a 5% deduction in a margin of safety. Looking at the margin, it has also gone up over the years, going from 23% to 14%, going from 2013 to 2014, but climbing up all the way back to 25% in 2022. This average margin growth is then sitting at 8%, which is way past the bright green part of a scale, indicating yet another 5% deduction in a margin of safety. The next metrics that we'll be looking at are the dividend growth and debt to EBITDA. The dividends have gone up very nicely over the years, going from $2.80 a share in 2013 to $5.60 a share in 2023. The average growth rate in the dividends during this period has then been sitting at 7.3%, which is once again in the light green part of a scale, indicating yet another 5% deduction in a margin of safety. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for MAA, this is just over 3 years. In this case, a 325% debt to EBITDA ratio, which is in the red part of a scale, indicating a 5% increase in a margin of safety. And the final 2 ratios that we'll be looking at are the occupancy rate and rent reversion rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. The occupancy rate for MAA is sitting at a very solid 96%, meaning that only 4% of their property is vacant and not generating any rent. This is a very good ratio, as I previously mentioned, and it's in the bright green part of a scale, indicating yet another 5% deduction in the margin of safety. The rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. As we can see in the top right corner, the rent margin has gone up significantly, going from over 11% in 2018 to over 13% in 2022. The average growth rate in the rent reversion has been sitting at 3.5%, which is in the orange part of our scale, meaning no change in the margin of safety on this metric. Looking pretty good so far for mid-American apartment communities, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the price to FFO mean reversion. Price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued and is expected to revert to its mean over time. As we see, there's only little info that I could find, but I can find 2 years of FFO per share data. And this gives us an average price to FFO of the past 2 years of almost $22. And if we do it for the trailing 12 months data, we can see that the trailing 12 months price to FFO is sitting at 14.25, implying that there's an upside to the stock price. And this gives us an average price per share out of this model of $197.12, which is an upside of over 53%. The second model that we'll be using is the dividend discount model. The dividend discount model is a valuation method that calculates the present value of expected future dividends to determine the fair value of a stock. It assumes that the intrinsic value of a REIT is the sum of all its expected future dividend payments, discounted back to the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by the REIT's dividends, and that future dividends are a crucial factor in determining the stock's worth. In this case, we've imported the dividend payments of the past 5 years of MAA, and on average they have grown their dividends by over 10%. And I'm projecting all of their future dividends to grow by 6%. I will be using a discount rate of 9% in this valuation, leaving us with a dividend discount model price per share of $197.87, which is an upside of almost 54%. The next model that we'll be using is the AFFO multiple valuation. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain a property portfolio. AFFO is considered a more accurate representation of cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. In this case, we've imported 2 peers and their price to AFFO ratio, giving us an average price to AFFO ratio in the industry of 17.94, while the price to AFFO of MAA is sitting at 16.60, indicating that there's an upside to the stock, and this gives us an intrinsic value of this model of $138.94, which is an upside of over 8%. And the last model that we'll be using is the net asset value model. Net asset value is a straightforward valuation model that estimates the fair value of a REIT based on the fair market value of its underlying assets minus its liabilities. The value of a REIT's assets is typically determined by the appraisals of its real estate properties. Net asset value can provide a good indicator of a REIT's intrinsic value. Doing this, we will be using the net operating income of MAA and apply a growth rate to it for our forward year net operating income. Then we apply a cap rate, in this case of 4%, and this gives us the value of their properties. We subtract the debt from it, and that leaves us with a net asset value of $11.7 billion. And dividing this by the amount of shares outstanding, we get a net asset value price per share of $100.44, which is a downside of almost 22%. Now that we have gone through all of our valuation models, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the price to FFO, discounted dividend, AFFO multiples, and the net asset value price per share, giving us an average of $158.59. A margin of safety we've determined it before, using a standard margin of safety of 25%, deducting it by 5% for the EBIT growth, margin growth, dividend growth, and occupancy rate, and adding 5% for the debt to EBITDA, leaving us with a margin of safety of 10%. Applying this margin of safety, we get a fair value of $144.17. And with the current price of $128.56, we get an upside of over 12%, indicating that per our valuation, it is a buy. Now, if you want to get access to all of the valuation models that I use in this video and all of my other videos as well, together with QuantView, my stock insight tool, you can check in the description for one Patreon link. And yeah, checking this out would support me a lot. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.